Welcome back to the deep dive. This is where we distill complex analysis into high-impact takeaways, giving you a clear shortcut to being well-informed.
And today we're taking a really fascinating trip into the Danish financial sector.
We're heading to the highly developed AAA-rated economy of Denmark to dissect what looks like a classic financial paradox. We're looking at Jyske Bank AS.
Right, which holds the title of the country's third largest financial institution.
And if you just skim the headlines, if you just do a quick screen on this, Jyske Bank looks like the perfect conservative value play.
It really does. You see a stock that seems to be trading cheaply, a seemingly low price to earnings multiple.
A PE that catches your eye.
For sure. And a highly disciplined management team that is aggressively, and I mean aggressively, returning capital to shareholders through buybacks.
It's exactly the kind of setup that, just draws in those deep value investors who are looking for safety and yield, especially in a pretty volatile European market.
Absolutely.
But that initial, positive surface impression is the exact paradox we need to tackle today. Is Jyske Bank genuinely cheap?
Right. Is the market missing something?
Exactly. Has it somehow missed a growth story or an efficiency breakthrough? Or is it, as our deep dive analysis suggests, structurally constrained?
Meaning, is it priced exactly where it should be?
Yes, because of some fundamental, almost permanent ceiling on its returns.
And our sources, well, they point emphatically to the latter. We're defining Jyske Bank as a structurally trapped utility.
Utility, that's a key word.
It is. It's an excellent, very well-run business, no question, but it's one operating within a framework that imposes a near-permanent ceiling on its return on equity.
And the main mechanism causing this constraint, the thing you really have to understand the stock, is the bank's integrated architecture. Jyske runs this massive, capital-intensive mortgage institution, Jyske Real Credit, right inside the bank.
Right. It's not a separate entity. It's all on one balance sheet.
And while this structure brings immense stability, it also acts like a huge drag chute. It dilutes the overall profitability of its much higher margin units like commercial banking and leasing.
Correct. And what that means, mathematically, is that the group just cannot achieve the kind of stellar ROEs you see from its more agile, capital-light, regional Danish peers.
It's a design choice.
It is a very deliberate design choice with profound financial consequences.
So our mission today is to move completely past the allure of those aggressive buyback headlines.
Yeah, look under the hood.
We need to dissect the highly competitive Danish landscape, understand the specifics of this capital efficiency trap, and then determine the long-term value creation potential.
And this deep dive is based on a really rigorous Jyske Bank investment analysis, focusing specifically on competitive positioning, capital use, and all those key efficiency metrics within this highly unique market.
Let's unpack this structural puzzle.
So to really appreciate Jyske's competitive position, we have to start by setting the scene in Denmark.
Right, the context is everything here.
It is, because its financial system isn't static at all. It's undergoing a significant, almost violent transformation.
Violent? Hey.
Well, in a corporate sense, the market is defined by extreme digitization, which has led to a massive reduction in branch networks. And critically, a brutal consolidation wave.
So lots of M&A.
A ton. Yeah. And by 2025, the competitive structure has really settled into what the analysis terms a clear, tiered oligopoly.
A tiered oligopoly. That sounds less like a stable economy and more like a high-stakes competitive Game of Thrones.
That's not a bad way to put it, actually.
Jyske Bank has historically been a significant player, but where exactly does it land in this new rigid hierarchy?
It has landed smack in the squeezed middle.
The squeezed middle.
Yes, and the pressure is coming from both above and below. We can clearly delineate the Danish landscape into 4 tiers, and Jyske is, frankly, struggling to maintain its positioning against challenges from pretty much every side.
Okay, let's start at the top. Let's define the top tier, the undisputed national champion. That has to be Danske Bank.
Danske Bank is the Goliath. There's no other way to say it. It's the undisputed heavyweight, defined by sheer scale.
And what kind of scale are we talking about here?
They dominate the market with a gargantuan balance sheet. We're talking something exceeding DKK 3.6 trillion.
3.6 trillion.
Yeah. To put that in perspective, that's almost 5 times the size of Jyske Bank.
Wow.
And this scale, it translates into approximately 26% of the total lending market share. Yep. So this isn't just a big bank, it's a strategically advantaged bank.
Okay, so what does that strategic advantage look like on a financial statement? How does that manifest?
It gives them a critical competitive tool.
Okay.
Cost amortization. Danske can amortize massive fixed costs.
Like IT systems, compliance.
Exactly. Complex IT, huge regulatory compliance infrastructure, data security, all of that gets spread across an enormous revenue base.
So their per unit cost is just structurally lower for those big ticket items.
Precisely. And this allows them to sustain operational efficiency even with immense complexity. And what's more, in the lucrative corporate banking segment, Danske uses this scale to aggressively price large mandates and syndicated loans.
Making it very tough for Jyske to compete on the big deals.
Nearly impossible to compete effectively on pricing or reach for the largest institutional clients. And despite some of its, legacy issues, Danske has successfully rebuilt its franchise and is delivering mid-teens ROEs.
So it proves that scale, when it's managed well, is a very powerful moat.
A very powerful moat.
Okay. So Tier 1 is defined by this overwhelming scale dominance, setting an almost impossible bar on cost efficiency for major projects. Now, let's bring in Jyske Bank.
Jyske Bank sits firmly in Tier 2, which we're categorizing as the challenger.
The challengers.
They are the clear number 3, with total assets hovering around DKK 750 billion.
Okay, so that's substantial.
It is substantial, but again, dwarfed by Danske.
Yeah.
Their core bank lending share is respectable, but it's limited. It sits somewhere between 10 and 12%.
And Jyske's challenge isn't just competing with the giant above it.
No, it's being squeezed laterally and from below.
And the major lateral squeeze comes from the other Tier 2 giant, Nykredit, especially after their merger activities in 2025.
That is the key strategic development of the last few years. Nykredit, which was already Denmark's dominant mortgage provider.
The biggest name in mortgages.
By far. They executed a masterstroke by acquiring Spar Nord Bank in 2025.
And that wasn't just about getting bigger, right?
No, this wasn't just a merger of balance sheets. It was a merger of distribution and focus. Spar Nord brought with it this extensive branch network and, critically, very lucrative high-return relationships in the SME segment.
Small and medium-sized enterprises.
The bread and butter of regional banking.
So Nykredit basically transitioned from being a pure mortgage behemoth to a hybrid bancassurance powerhouse overnight.
Almost overnight, yes.
How does that specifically threaten Jyske?
It threatens Jyske directly at its core. Jyske's entire model is predicated on being the best hybrid commercial bank and integrated mortgage provider.
The all-in-one solution.
Exactly. And now, Nykredit Spar Nord rivals Jyske in ambition, but operates with a fundamentally more capital-efficient model, the total credit model, which we'll get into in detail in a moment.
Okay.
This combined entity now targets the exact same customer base, affluent, retail, high-quality SMEs, and that effectively creates a competitor that matches Jyske's size and target market, but with a structurally leaner capital profile.
So if the top two tiers are squeezing, I imagine the competition from Tier 3, the so-called efficiency kings, must be equally brutal.
It is.
Tell us about the recent consolidation there.
Tier 3 is where the real cost-competitive pressure originates. This tier is defined by these newly formed entities that manage to match Jyske's scale in key segments.
But with better efficiency.
Exactly. They achieve superior efficiency.
Yeah.
And the prime example of this is the newly minted AL Sid Bank.
Right, a merger of 3 banks.
Yes. A massive regional player formed by the late 2025 merger of Sid Bank, Arbeidernes Landsbank, and Vestjysk Bank.
That's a huge combination. So how does AL Sid Bank as a combined entity actually rival Jyske?
It rivals Jyske by achieving critical mass in corporate and SME lending volume. But the heritage of these combined banks, especially Sid Bank, is a historically leaner cost structure.
What's that rooted in?
It's rooted in tight regional management and less complex IT systems compared to a full-stack universal bank like Jyske. They're just laser-focused on minimizing their cost-income ratios.
Which allows them to retain higher margins on the same revenue base Jyske generates.
That's exactly right.
So Jyske is now in a situation where Danske Bank can outinvest them on tech and corporate pricing, while AL Sid Bank and the new Nykredit entity can meet or beat their efficiency in the regional and SME market.
A classic pincer movement.
Who sets the absolute standard for efficiency, though? The gold standard.
That gold standard remains Ringkjøbing Landbo Bank. They are the outlier, the benchmark for operational excellence in Danish banking.
And they're smaller, right?
They're smaller in absolute balance sheet size, yes. But they consistently deliver return on equity figures above 20%.
20%. That's incredible.
It is. And they maintain a phenomenal cost-income ratio, often dipping into the low 30s. They really prove that efficiency isn't just achievable, it's the dominant competitive weapon in this middle market.
The implication for Jyske, then, is that the narrative has utterly collapsed. They were once the established alternative to Danske Bank.
Exactly. That was their whole pitch. They were the credible number three, large enough to handle sophisticated business, but perceived as more localized and customer-focused than the scandal-ridden behemoth.
But that differentiation has just evaporated.
It has. They now face two new competitors, AL Sidbank and Nykredit Spar Nord, that have matched their scale but surpassed their efficiency. It's completely eroded their historical middle market niche.
And what about their growth strategy? They used to be a consolidator.
Well, that's the other problem. Their historical consolidator premium, the idea that they could continue to grow by buying up smaller, profitable banks, is now moot.
All the good targets are gone.
They've all been consumed in this consolidation wave. Jyske is facing a fully armed field with nowhere obvious to expand, either organically or inorganically.
That sets the stage perfectly for the core financial problem. If competitive pressure is rising and the M&A runway is closed, Jyske needs spectacular organic returns.
Oh, it is.
But you're arguing their internal structure just won't allow it.
No. Okay, let's transition to that structural anchor, the financial mechanism that mathematically caps Jyske's returns. This is really the heart of the deep dive.
It is.
It revolves around the distinct nature of the Danish mortgage system. It's the core reason why breaking that 10 to 12% return on equity ceiling is so profoundly difficult for them.
This is the moment where the global nature of Jyske's business ends and the Danish peculiarity begins. It's a really unique system.
So explain this model. The Danish mortgage model is unique worldwide. It relies on what's called match funding.
Match funding.
So this means that when a mortgage is issued to a homeowner, the bank simultaneously issues a corresponding covered bond with the exact same terms, and the proceeds from that bond sale fund the loan.
Okay, and why is that so critical for the bank? What does that do for them?
Because the interest rate risk is entirely eliminated for the bank.
Entirely.
Entirely. If interest rates rise, the value of the bond falls, but the value of the mortgage asset also falls equally. The bank just nets the two positions.
So they're perfectly hedged by design.
By design. It's a system built for stability and borrower protection, but by that same design, it becomes a highly commoditized, low-risk, and therefore very low-return activity for the issuer.
So the profit isn't in the interest margin, the spread.
No, the profit is in the administration fee. That's it.
Now let's introduce the two competing business models, because this single architectural choice is what separates Jyske's performance from its peers.
And the difference is all about capital allocation.
Okay, so let's start with Jyske's way of doing things.
The first is Jyske's integrated model, which is run through Jyske Real Credit. Jyske owns the full value chain. They handle the origination, the bond issuance, the servicing.
Everything, soup to nuts.
Everything.
Yeah.
And they retain the entire administration margin, the bedragsats as it's called. However, the critical financial consequence is that Jyske must hold the capital-intensive mortgage assets on its consolidated balance sheet.
Okay, and holding those assets means applying capital against them, specifically risk-weighted assets, or RWA.
Exactly. The loan principal, which is massive, we're talking a DKK 382 billion nominal portfolio size.
Wow.
That has to be backed by equity capital. And even though these assets are very low risk, Basel and the fee requirements mean that the capital density required for mortgage books has increased substantially.
So it's become even more capital intensive over time.
It has. And because the returns on this specific segment are capped by regulatory and market mechanics, this massive mortgage business generates an ROE of only about 8 to 9% through the cycle.
Wait, hold on. Let me just make sure I understand the consequence of that. Jyske Bank is deploying hundreds of billions of kroner in capital into an asset that, by its very design, will only ever yield 8 or 9% ROE.
Precisely. That is the lead anchor. The moment that 8 to 9% asset book is blended with the bank's higher-yielding corporate and SME lending, which might achieve, say, 15 or 16% ROE.
It just drags the whole average down.
The overall aggregate group, ROE, is mathematically diluted down to that 10 to 12% level. The sheer size of the mortgage portfolio dictates the corporate average.
Okay, that is crystal clear. Now contrast that with the competitor model, the one used by the efficiency kings like Sidbank and Spar Nord.
They utilize the Total Credit Alliance model.
The alliance model.
Right. These banks are not the legal issuers of the covered bonds. Instead, they act purely as distributors for the Nykredit-owned Total Credit.
So they're just the storefront.
A very profitable storefront. They originate the loan, they service the client, and they receive a hefty commission income, which is a substantial share of that administration margin.
So what's the magical trick here for these distributing banks?
The magic is that they hold zero capital against that DKK 382 billion loan principal.
Zero.
Zero. They book the commission income as capital light fee revenue. Their equity is only allocated against their much smaller but much higher yielding commercial and SME lending book.
So they get the best of both worlds. They get the fee income from the safe mortgage business without having to tie up any capital.
It allows them to achieve an incredible arbitrage. They can fully leverage their equity into activities that yield 17, 18, or even 20% ROE.
That's the core structural difference. Jyske chose control and integration, but paid for it by having their equity diluted by low-yielding assets.
While their peers chose capital efficiency by sacrificing control, but gaining the freedom to allocate equity purely to the highest return activities.
That's why that 10–12% ceiling is structural, not operational.
Exactly. Jyske could be managed perfectly, but as long as they hold DKK 382 billion worth of assets that only yield 8 to 9% ROE, they cannot mathematically match a peer who allocates 100% of their equity to 17% plus ROE activities.
The structural setup is the key constraint.
It's the primary reason for the persistent performance gap. The analysis confirms it.
But wait, let me play devil's advocate for a second here. In a global recession or a severe real estate crash, that 8–9% ROE mortgage book, that structural anchor, suddenly looks like a massive safety blanket, doesn't it?
That's an excellent point.
I mean, it's low return, but it's high quality, it's matched funded, and inherently low risk. Isn't Jyske essentially prioritizing rock-solid stability, which is highly valuable, over optimizing for peak returns?
That is an excellent point. It perfectly encapsulates the trade-off. Jyske is prioritizing stability.
Right.
The fact that their mortgage assets are match-funded means their balance sheet is extremely robust in the face of interest rate swings or funding shocks. They are much less reliant on volatile wholesale funding markets than some of their pure-play competitors might be.
So they sleep better at night.
They're buying regulatory ease and balance sheet confidence, absolutely.
Oh.
However, the market, particularly post-2022, is rewarding high ROE efficiency more than it's rewarding high balance sheet stability, provided, of course, that asset quality remains pristine.
And the price Jyske pays for that stability is the permanent constraint on their valuation multiple.
Which is exactly what we'll get to later.
Yeah.
Okay, so now that we've established the structural handicap, let's see how it actually manifests in the core financial metrics. We're moving from the theory to the empirical evidence.
And the ultimate litmus test for any bank is its return on equity. If Jyske is truly structurally constrained, we should see a consistent lag against its regional peers.
And the lag is massive, and it is consistent. Let's look at the numbers reported as of Q3 2025. Jyske Bank reported a return on tangible equity, or ROTE, of approximately 12.0%.
Which, in a European context, is not bad.
It's respectable, absolutely.
Yeah.
But let's compare it to the total credit partners who operate that capital-light distribution model.
Right, the efficiency kings.
Sid Bank achieved 17.4% ROE in the same period, and Spar Nord was right there at approximately 18.0%.
So a 500 to 600 basis point gap. That is the quantifiable cost of carrying that DKK 382 billion mortgage anchor.
Absolutely. The structural handicap is confirmed right there in the numbers. Jyske's sustainable ROE ceiling is around 10 to 11% through a full cycle.
Whereas the other guys.
The capital-light banks can sustain ROEs in the mid to high teens because their equity is exclusively deployed into high-margin activities like specialized corporate loans and high-yield SME lending.
So there's just no competitive advantage in profitability for Jyske at the group level, only stability.
That's the trade-off.
Okay, so if profitability is lagging, the only way to offset that is through exceptional operational efficiency. So how does Jyske's cost-income ratio, the CI ratio, stack up against those efficiency kings?
Jyske's CI ratio typically hovers around 50 to 52%.
50 cents on the dollar just to run the place.
Pretty much. Now, they successfully dipped below 50% in the most recent quarter, Q3 2025, which is a commendable result.
And that was driven by the Handelsbanken synergies.
Yes, realizing those synergies from the acquisition. And that shows operational competence. However,
There's always a however.
the efficiency kings Sid Bank, and especially Ringjobing Landbo Bank, operate consistently in the low 40s or even the 30s.
A CI ratio in the 30s is world-class.
It is.
So why is Jyske's ratio structurally higher than a regional bank like Sid Bank? It's not just the mortgage business, is it?
It's the complexity cost of maintaining a full-stack universal bank. Jyske is not just lending money. They're managing a massive IT infrastructure. They're maintaining sophisticated corporate banking platforms. They're running the bond issuance desk for Jyske Real Credit.
And the regulatory burden is huge.
Immense. They're navigating all the regulatory reporting requirements that come with being a systemically important financial institution. They have to cover the whole spectrum, from basic retail to complex investment banking services, but they do so on a revenue base that is 4 to 5 times smaller than Danske Bank.
So they have the complexity of a giant, but not the scale to amortize the cost.
That complexity is expensive to maintain, creating a structural efficiency challenge compared to those focused regional banks.
So we have high complexity, lagging efficiency, and a huge asset anchor. I mean, that combination usually forces a bank to take on higher credit risk to boost returns. Yet Jyske is famous for its conservatism, right?
Indeed. Their strategic response to these structural pressures is to lean heavily into creating an asset quality moat.
An asset quality moat.
Jyske is extremely cautious. They have recorded near zero or even positive loan impairment charges for several years.
Positive, so they're getting money back.
In Q3 2025, they realized DKK 22 million from provision reversals, meaning they released reserves set aside in prior years because the expected losses never materialized. Their non-performing loan ratio is very low, indicating a very clean loan book.
But the truly unique feature of this conservatism, the part that generates the most debate among analysts, is the DKK 1.9 billion cookie jar.
The post-model adjustments, or PMAs.
Explain what that means and how management uses it.
The PMA buffer is the most striking conservative feature. This DKK 1.9 billion is not a specific provision against an identified bad loan. It's a management overlay.
So it's just a general rainy day fund.
An extra layer of capital reserve purely for uncertainty. Think geopolitical risk, unforeseen supply chain disruptions, or macro shocks in the commercial real estate sector. It's an explicit hedge against the downside.
Now, the critique often leveled at these kinds of overlays is that they can be used to manage or smooth earnings. How would Jyske potentially use this DKK 1.9 billion to smooth their income statement?
It provides management with significant discretion. In a benign credit environment where actual loan losses are low, management can slowly, strategically release portions of this DKK 1.9 billion buffer back into the income statement.
So if NII is weak one quarter,
they can release some of the PMA to make the number. This is often done by reversing the provision directly into the net interest income line or the impairments line. This maneuver allows the bank to offset operational headwinds and ensure that reported earnings are stable,
meeting analyst expectations.
even when core operating leverage might be weak. It protects the downside, absolutely, but it does mean reported earnings aren't always a pure reflection of the underlying business performance in any given quarter.
Okay, let's turn to the massive external headwind that is now hitting all European banks, the interest rate cycle inflection point. The period from 2022 to 2024 was defined by massive tailwinds.
It was a gold rush for banks. Central banks moved rates from negative territory up to nearly 4%.
And Jyske, with its enormous sticky deposit base, benefited profoundly.
They were slow to pass those rate hikes on to customers, a metric known as a low deposit beta. This created massive widening margins on their deposit book, inflating their net interest income, or NII.
But the cycle has turned. Denmark's National Bank and the ECB are now cutting rates, which started in 2025.
And Jyske is highly sensitive to policy rate changes. In a rate-cutting cycle, the mechanism just reverses. The bank's lending yields fall mechanically with the reference rates.
And depositors get smarter.
Exactly. Customers become more sophisticated, they shop around, they demand better rates for their deposits, the deposit beta rises, and deposit margins compress rapidly.
And this is a big deal for them.
The analysis stresses that this NII compression is a critical drag and is expected to bottom out only in 2026. This means Jyske faces a sustained period where its core earning engine NII is under structural pressure, making the struggle to push ROE above 12% even harder.
They benefited immensely on the way up.
And they will feel the pain acutely on the way down.
Given these structural constraints, you've got the mortgage anchor, the lagging efficiency, and now these rate headwinds management can't just rely on external factors or core growth alone.
No, they have to be proactive.
So they must pivot the business model and optimize capital allocation. Let's look at their strategic response, starting with where the true profit drivers actually lie.
When we dissect the Jyske conglomerate, the profitability story is very specific. The core profit driver, excluding the stable but low-yielding mortgage business, lies in banking activities.
So the traditional bank.
Specifically, corporate, SME, and leasing. Jyske focuses on affluent customers and slightly larger corporate mandates than the efficiency kings.
And I noticed the sources called out leasing as a hidden gem. Why is that segment Jyske Finance so important for them?
It's vital because it offers high yields and significant diversification. Jyske Finance is a leader in car financing and equipment leasing in Denmark. This activity is inherently higher yielding than standard mortgage or, vanilla corporate lending, so it provides a natural uplift to the group's overall margin.
And it's less rate sensitive.
Critically, yes. It is less directly dependent on the central bank's policy rate than the core mortgage and deposit books. It offers a genuine hedge against that NII volatility we just talked about. It's a clean source of high return.
Okay, and the second area of strategic focus, which is designed to circumvent that capital trap, is shifting revenue toward capital-light fee income, specifically wealth management.
Exactly. This is their path to ROE accretion without increasing their risk-weighted assets. They made a very smart, successful pivot to accelerate growth in these fee-generating businesses.
And the PFA bank acquisition helped with that.
It was a huge boost, yes. That, combined with favorable equity markets, drove their assets under management, or AUM, up by a remarkable 17% in 2024.
And because it's fee-based, it's great for ROE.
It's naturally ROE accretive because it uses very little capital. It helps pull the group average up. And Jyske has a strong starting point here. They consistently rank #1 in private banking services in Denmark.
So that's a tangible brand asset that supports expansion in this high-margin area.
A very strong one.
So management is making these smart, surgical moves to boost returns internally. Historically, though, Jyske's growth has been defined by inorganic growth, buying its way to scale.
That M&A history is crucial to understanding management competence. The 2022 acquisition of Handelsbanken in Denmark was a truly transformative event.
Huge deal.
It added DKK 66 billion in loans and 130,000 affluent customers. This deal was so substantial that it essentially masked the underlying lack of organic growth in the Danish core market for 2 years.
And how did they do on the integration?
The most telling success indicator is that management completed the integration ahead of schedule in 2024, realizing over DKK 300 million in cost synergies.
That's a huge positive point for management quality. It proves they can execute.
Absolutely.
But now we circle back to the competitive structure. The M&A runway is closing fast.
It is functionally closed. The consolidation wave we detailed, like Credit Spar Nord, AL Sydbank, it's consumed the remaining attractive regional targets.
So there's nothing left to buy.
The analysis confirms Jyske is now in a difficult position. They are too large to buy small local banks efficiently, as the integration costs and friction would just outweigh the marginal returns.
And they can't buy a big peer.
No, they aren't large enough or politically positioned to buy another Tier 2 player. This forces them to rely on organic growth, which is where the struggle truly begins.
And what do the organic numbers tell us? Are they growing?
They tell us the market is completely saturated. Bank lending volumes for Jyske have been flat or even negative, down 1% to 2% in 2025.
So they're actually shrinking a bit.
And this shows the difficulty in achieving growth in a highly competitive, digitized market. It also suggests that management is prioritizing maintaining tight margins and high credit quality over chasing risky volume growth.
Which is probably smart.
It is, but it doesn't solve the growth problem.
So this inherent stagnation, the closed M&A road, and the difficulty of organic growth brings us to the central feature of the investment case, the capital allocation strategy.
Right.
If profit growth is capped and the ROE is diluted, how do you reward shareholders?
You deploy the cannibal strategy.
The cannibal strategy.
Jyske Bank operates with a relentless, shareholder-first philosophy under CEO Lars Mørch. Since they cannot profitably deploy all the capital they generate internally,
They just give it back.
they return it aggressively.
Okay.
The bank is committed to repurchasing approximately 5% of its outstanding shares annually.
5% annually is massive. They were authorized for a DKK 2.25 billion buyback program in 2025.
Right.
How does this create shareholder value when net profit is capped?
It creates artificial earnings per share growth. It's simple math. If the bank's net profit remains flat, but the number of outstanding shares shrinks by 5%, the EPS mechanically rises by about 5%. This is really the only way for a stable, non-growing utility with a capped ROE to generate reliable EPS expansion.
And it signals a lot of confidence from management.
A profound conviction that their own stock is undervalued relative to the returns they can generate internally.
They also shifted their distribution philosophy recently, adding a cash component to the buybacks.
Correct. They transitioned to a hybrid distribution model in 2024. So approximately 30% of the distribution is now via a cash dividend payout around DKK 24 per share.
Supplemented heavily by those aggressive buybacks.
And this shift is pragmatic. It widens the appeal of the stock. It attracts income funds and conservative institutional investors who require a steady, regular cash dividend.
So when you combine that dividend yield with the buyback yield, the total picture for the investor is actually highly compelling.
It transforms the stock into a bond proxy. The combined distribution yield dividend plus buyback is highly attractive, sitting around 7 to 8% at current prices.
And that's a great deal for some investors.
For conservative investors seeking reliable income from a stable, AAA-rated economy, this is a premium proposition. They are buying the stability of the Danish system, guaranteed by Jyske's conservative balance sheet packaged with a massive, predictable capital return.
And this commitment to capital return is enforced by specific internal targets, isn't it? It's not just a suggestion.
No, it's hardwired. Management targets a very precise CET1 ratio of 15 to 17%.
CET1 being the core capital ratio.
Core capital, yes. The bank was at 16.2% as of Q3 2025, after reserving for the full buyback program.
So they're very disciplined.
The crucial takeaway here is discipline. Management is not hoarding capital or engaging in wasteful diversification projects. They are effectively saying, if we cannot generate returns above our cost of equity by deploying this capital internally, we must return it to you.
And you mentioned the CEO bought shares.
Yes. The CEO's share purchase in late 2025 sends a very positive signal of confidence in the underlying value of the franchise. It's a clear alignment of interests. Okay, so now we move to the final section. We need to synthesize the risks, the competitive pressures, and the operational stability into a single, cohesive valuation verdict.
And before we get to the big credit risks, we have to acknowledge the persistent, if minor, regulatory issues that demonstrate the continuous high cost of compliance in a regulated European market.
Compliance is a heavy systemic burden. It never goes away. Jyske accepted a DKK 24 million fine in December 2024 for specific anti-money laundering, or AML, failures.
And financially, 24 million is nothing to them.
It's immaterial, yes, but it confirms the ongoing pressure on their internal operational controls. And more broadly, the Danish FSA also criticized Jyske, alongside its major competitors, Danske and Nykredit, for systemic failures in recording trading communications.
So it's an industry-wide problem.
It is. But these are not strategic failures, they're operational. But they confirm that maintaining a universal bank license requires massive, perpetual investment in IT and governance.
Let's transition now to the major downside risk embedded within the integrated model, real estate concentration. This is tied directly to the sheer size of that Jyske real credit book.
This is the primary credit risk center, no question. A substantial 73% of Jyske's total loan book is concentrated in real estate exposure.
73%.
And that exposure is categorized into two main parts. You've got 36% residential, which is highly diversified and historically very safe in Denmark, and then the key vulnerability, 19% commercial real estate, or CRE.
And the CRE market is the global risk center right now, particularly with increased debt servicing costs and pressures on office vacancy rates post-pandemic. How exposed is Jyske's 19% book?
The analysis highlights that while Jyske is generally well collateralized, the CRE segment is precisely where the risk lies. And this exposure is large enough that the Danish regulators are paying very close attention.
What are they doing?
The Danish Systemic Risk Council has targeted this exposure specifically, maintaining a 7% sector-specific systemic buffer.
What does that systemic buffer actually mean for Jyske? What does it force them to do?
It means they must hold an additional 7% of capital, specifically against those commercial real estate exposures. It further increases the RWA density for that segment.
So it makes an already capital-intensive business even more capital-intensive.
Exactly. This policy is designed to reduce systemic risk for the country, but for Jyske, it exacerbates the capital allocation problem we've been talking about. It forces them to tie up more capital against a potentially riskier yet mandatory segment of the market,
reducing their flexibility to deploy capital elsewhere.
Precisely. And while they also have exposure to sectors like agriculture, which has been a historical trouble spot in Denmark, the CRE book and the resulting 7% buffer are the most potent credit vulnerability, especially if the current high-rate environment causes debt distress among regional CRE developers.
Okay, so we've established high credit risk concentration, Rate headwinds, intense competitive isolation, but also robust asset quality and superb capital discipline. Let's bring it all home. What is the valuation verdict?
The verdict is crystal clear. Jyske Bank is fairly valued. And we must emphasize this strongly because many casual investors see the low PE and the 70% yield and assume it's a bargain.
And it's not.
It is not. The current pricing is entirely justified by the structural constraints we have detailed over the last half hour.
As of early 2026, the bank trades at a price-to-book, or PB ratio, of approximately 1.0x, right on book value. Why is that the correct price for this institution?
Because the valuation of a bank is fundamentally linked to its sustainable return on equity versus its cost of equity. It's a simple formula.
Right.
A bank with a structural ROE ceiling of 10 to 11%, which is Jyske's sustainable level through the cycle, should trade roughly at book value in a market where the cost of equity for a stable bank is typically 9 to 10%.
So you're paying exactly 1 krone for 1 krone of equity, because that krone is only generating the bare minimum return necessary to justify its existence.
You've got it. It's not creating or destroying value. It's just treading water from a valuation perspective.
So the discount they trade at relative to peers like Sidbank is entirely rational. The market is not missing a thing. It's simply pricing the structural design flaw.
Precisely. Look at the contrast. Sidbank trades at approximately 1.4x price to book.
So a 40% premium?
Why the premium? Because Sidbank generates 500 to 600 basis points more ROE, consistently hitting 17% plus co. Investors are willing to pay 1.4 times book for a high-performance capital-light engine.
And they are paying 1.0x book for Jyske, the stable, conservative utility.
The market is pricing Jyske efficiently as the stable bond proxy of the Danish banking sector. It values stability over growth potential.
What, hypothetically, would it take for Jyske to achieve the multiple expansion that would allow it to trade up to, say, 1.2x PB? Is there a path?
The analysis is pretty uncompromising on this point. To justify a 1.2x price-to-book multiple, Jyske would need to structurally lift its aggregate ROE to 13 or 14%.
And that's impossible with the mortgage book.
Given the permanent drag imposed by the DKK 382 billion 8 to 9% yielding mortgage book, that is virtually impossible without a radical corporate restructuring. This would likely involve divesting or spinning off Jyske Real Credit entirely.
And becoming like their peers.
Moving to a total credit-like distribution model and reallocating all that freed-up capital into high-margin activities.
The final thesis, then, is that Jyske Bank is trapped. It's a high-quality institution that has made a conscious choice for structural stability, but that choice permanently limits its return profile and, consequently, its valuation.
It is a strong hold for conservative, income-oriented investors who value that safe, predictable 7 to 8% yield. But for growth-oriented investors, there is minimal potential for capital appreciation through multiple expansion. It's a beautifully managed utility, but it is priced like one.
This has been a truly illuminating deep dive into how strategic architecture, even in a stable economy, can create a permanent constraint on financial performance.
We covered a tremendous amount of detail today. If you remember nothing else, hold on to these 3 structural points. First, Jyske is stuck in the competitive squeezed middle.
Right. Outgunned by Danske's scale.
And out-efficiented by the merged entities like AL Sidbank and Nykredit Spar Nord.
Second, the integrated mortgage book, Jyske Real Credit, is the structural anchor.
It consumes vast amounts of equity capital, which, by yielding only 8 to 9% ROE, dilutes the group's aggregate ROE to a sustainable ceiling of 10 to 12%. That gap is the direct cost of their choice for control.
And third, management's aggressive cannibal strategy.
Returning DKK 2.25 billion annually through buybacks and dividends, which ensures a high, safe floor for the stock price. This confirms Jyske's status as a compelling yield-generating utility, efficiently priced at book value.
And despite all those structural anchors, competitive pressures, and rate headwinds, we have to close by noting Jyske's resilience. They recently raised their 2025 earnings outlook to DKK 5.4 billion.
For approximately DKK 85 per share.
That speaks volumes about the quality of the underlying banking franchise and the conservatism of their forecasting.
A very strong operational achievement in a difficult environment.
Which leads us to our final provocative thought for you to mull over. Our analysis suggests Jyske Bank is trapped by its own stability. The path to achieving the ROE needed for multiple expansion to break that 1.0x book value ceiling requires a radical solution, divesting or spinning off Jyske Real Credit. What market pressure or what specific change in the regulatory landscape would it take for Jyske's discipline management team to abandon the structural safety of their integrated model in pursuit of higher returns?
And in the hyper-competitive Danish financial system, what's the better long-term moat? Is it stability or is it speed?